Today we're going to get into supply chain disruptions specific to COVID, and in particular with the export market from Australia. And our two panelists today are dialing in from Queensland, again, in the future. And we're going to kick off today with Kim Morrison. He is from Argyle Capital Partners and will give us a brief landscape of the export market as it stands now and how much it's grown. And then we are going to kick over to Tim McGavin from Laguna Bay, CEO there at Laguna Bay. And he's going to give us some of his insights. And they're going to do a little back and forth as we go along. And we have a few charts and graphs to share with you. They've asked that we encourage you to do Q&A throughout. So if a question pops up and comes to mind while they're speaking, go ahead and put it into the Q&A chat. And I'll address them as they come in as best we can. And then we'll have a longer period of Q&A at the end as well. Okay, so Kim, thanks so much for being here. I'll let you take it away.
Thanks very much, Kate, and thanks everybody for joining. And yeah, while we'd like to think that you're looking into the future, certainly here in Queensland, we've been one of the areas of the world that has seemed to have got on top of flattening the curve, and certainly we're starting to enjoy the ability to move around again and get back into business, at least within the state and within Australia, more and more coordinated to start opening things back up again. But from where we sit, it seems we are a long way ahead of other parts of the world, and perhaps that's just the benefit of being an isolated island on the southern part of the world. So this morning I'll just run through, just to set the scene a little bit, a few slides just to put in perspective the Australian ag export landscape in particular, to then contemplate what the impacts of this disruption have been. So I'm just going to pull up the screen to share with you. Okay, so the majority of Australia's ag production, as you probably know, is exported. Over 70% is going out. So we have a small domestic population, only 25 million, and a large agricultural capacity alongside that. And that's always been the case, but increasingly we have been targeting markets that are prepared to pay higher premiums. And we've moved over the last 20 years or so from I guess a focus around just exporting bulk commodities into global markets, really undifferentiated in a lot of ways, to increasingly seeing how we can value add that and move to servicing markets that have grown significantly in the last 20 years, particularly our near Asian neighbours, where we've written a lot of free trade agreements and benefited from their per capita income growth. And that's then led to a change in the mix of agricultural exports. Our largest market today is certainly China, taking just last year was just over $13 billion Aussie of our ag exports. Japan, the US, Korea, and Indonesia are the next ranked markets. And we'll talk a little bit today about how that has been changing. As I alluded to, some of the change in the mix of what we've been exporting in terms of the agricultural landscape has changed. So we've had over the last 20 years quite a lot of growth in meat and livestock exports out of Australia, up 34% over the 20-year period, but particularly fruit, vegetable, horticulture, wine, nuts, those sorts of crops have benefited enormously, and we've been focusing on that as a much higher returning export volume for the inputs that we have here. So we've seen significant growth there, whereas grains has tended to be fairly flat. We've been exporting grains for a long period of time, but a larger proportion of that is now basically value added, if you like, within Australia through feedlotting of livestock to get a greater return for that input. Our exports are quite diverse. We go across a lot of different countries through Asia. In particular, sort of this north-south trade is predominant. Obviously, those populations across Asia have been growing in population a long time, but it's more the impact of their per capita wealth increases, which has shifted their demand for food and fibre, and we've been benefiting from that through our growth over the last 20 years. China in particular has been a major growth market in that period. And some of the anecdotes, I guess, myself, I had a background in the cotton industry and sugar industry. I can clearly remember 20 years ago trying to break into that market as a large consumer and also producer at the time of cotton. Back in 2000, we basically sold less than 1% of the Australian cotton crop was going into that market. And over the next sort of 10 years, that grew significantly to a point where, in the early 2010s, we were selling near to 70% of the Australian crop was going in there for cotton. More recently, that's been reduced back around sort of 30% or so, but we have had a far lesser crop in the last couple of years. Anecdotally, at the same time, one of the things that we used to do is, take gifts to meet with the people who we were trying to transact cotton, and that was wine, was Australian wine. We thought was something that was symbolic. There wasn't much appetite for that at all back 20 years ago in China, and trade stats show that we really only sold $1 million of wine to China in the year 2000 in total. And today we're selling something in the vicinity of $3 million of wine a day to China, albeit that's at least temporarily slowed in the last little period. But I'm going to hand over now to Tim to continue the discussion on some of the other markets. Thanks, Tim.
Yeah, thanks, Kim. And to put Kim's comments into context here, you can see that you can see the ascendancy of the Asian nations themselves, and so certainly it's pretty obvious that Australia is overweight on exports to China, but there's a reason for that, and early since the 70s, culminating in a landmark report from Professor Ross Garnaut to the Australian government in the early 1980s of how we can really hitch our britches to Asia. We've had a massive focus on Asia, so it's only been natural that we've become overweight, probably the fastest growing and the largest economy there. But it's worth noting that this year, Asia overtakes the rest of the world in terms of GDP on a purchasing power basis. And so it's not all about China. There is many nations within Asia that have young populations, rapidly growing economies, and a big appetite for export. So this chart here shows what we're talking about. So only 20 years ago, China was back down on the bottom left where Indonesia is now. So certainly nations like Vietnam and South Korea are growing rapidly. These are 10-year compound average growth rates. So it's been the right horse to back. Asia, it continues to be the right horse to back. Reality is that we need each other. They need product. So disputes like we're seeing now with China over barley and things like beef. Barley, this probably has probably culminated in the political tensions over Australia recommending a proposal to run an independent inquiry into COVID-19 and the originations of that. We don't think that's an unreasonable request. In Australia, at least, if there's an unexplained death, there's a coronial inquiry. It makes sense, given the impact that coronavirus has had in the world, that we have an inquiry and really get to the bottom of how it originated, so we can hopefully stop the next one. So the barley dispute has been going on for 24 months now, so it's not new. And beef, we saw the same thing happening in beef in 2017, and what we saw actually was the Chinese consumer wanted Australian beef, so that's what they got. And there is still a shortage of protein in the world. Beef, particular, we've got massive disruption in Brazil at the moment with processors shut down. Likewise in America, so our beef will simply go to America and these other Asian nations. And I think it's going to be difficult to get product out of some of these emerging nations like Brazil that are having problems. So next slide, Kim, if you don't mind.
Yep.
Yeah. Is there one before that?
This one?
Yeah. No, yeah, that one, that one. I was actually
Yep.
spoken to that one. Okay, next slide. So you can see here, sorry, the next one. Yeah, this sort of summarises the point of this is a very messy chart, but it really shows the growth and the rankings of GDP globally over the last 20 years up to 2023. And you can see there that Indonesia overtakes Russia as the sixth largest economy in the next couple of years. And you can just see the growth rates of some of the other nations, and they're well ingrained growth rates here that aren't going to go away. So there is a massive push in Australia by all exporters and government to reweight our exports now into these other markets, and we certainly will. So I think with regards to China, what we'll see is just over the long term, we'll just create new markets, which will be brilliant for Australia. So that's it from me for now. Okay.
So just to perhaps add a bit more weight to what Tim was saying in terms of the rise of the Chinese market for Australia has been significant, obviously, and it is a big market for every agricultural exporter, not just Australia. I think geopolitically, obviously, what we're seeing in this last few months is increasingly, and perhaps over the last few years, we've seen China starting to exercise a little bit more of its political weight through this part of the world. And of course, overnight, we've also had news about some changes to legislation in Hong Kong, which has resulted in some declarations out of the US about Hong Kong's ongoing independence. And these are all issues that, perhaps we've been naive across the world to think that a country of that size of billion population plus is not going to want to have some sort of influence in world affairs, and that's perhaps something that has been overlooked by some for quite a long time. So it's a very interesting landscape, but at the end of the day, commerce goes on, and we are servicing that market because it has been something that has been quite lucrative relative to others. They have a large demand. They have an ability to take large cargoes and pay for every single item to the last dollar. They're things that have made it attractive relative to some other destinations from Australia. But certainly, I think out of this last few months, and Tim, I would agree, it's going to be a trigger for us to spend more time and effort developing some of the other markets to ensure that we have diversification. And on a commodity by commodity basis, certainly if you look at the stats, it's evident in some industries that they've been doing more or less of that, depending on which commodity you're looking at.
Even reading just annual reports that are coming out now, some of our listed agricultural stocks, and certainly commentary around the mix of weighting on exports. But it's worthwhile also putting it into context. There's just tens of thousands of Chinese buyers coming down to Australia every day, not in the last few weeks, couple of months, but just knocking on doors, wanting products. So it's been a relatively easy market for us to tap into. So it's a natural progression to see an overweight. And I think these disputes have shined a light on that. So it will be fixed. It'll create new markets over time. That could be some short-term pain.
And I guess the other...
sorry.
It's okay. Go, Kate.
I was just going to interject, if I may. We have a couple of questions. And I also, in a fit of narcissism, forgot to introduce myself, assuming that all of our listeners would know who I am. But I'm Kate Westfall with Global Ag Investing, and thanks again, everyone, for being here. We have a question coming in from Sid that asks if you've got any insight into how long the Foreign Investment Review Board will keep the most recently changed review rules in place. I guess it was recently extended to 6 months from 30 days. With $0 transaction value versus 15 million previously. Can one of you or both of you comment on that?
Well, yeah, there's no change really for agriculture. We already have a zero threshold for foreign investment here. So the only change really is that it's now across the board for our whole economy, and clearly they've extended the time they've given themselves to approve applications. So I think for businesses like Kim's and at Argyle and mine or ours at Laguna Bay, we've got we've been doing this for many years with FIRB. We've got great relationships, various exemptions, and they understand that that Kim's business and my business are very much 100% Australian owned and controlled in terms of management and representation. We might have foreign capital in our funds, so we are not the problem here. The problem that they're trying to stop is particularly laundered money coming out of some of these nations, and they're also trying to stop transfer pricing, where foreigners can come in here and sell them stuff back home at no margin and not pay any tax here. So there's other things at play here. So the only real impact, I think, on our businesses, Kim and my businesses, will probably be a bit more of a delay. But as I said, we're on the front foot. We've got great working relationships with FIRB, and so it shouldn't be a huge issue, but you never know.
Yeah, I guess in the setting that Australian agriculture has been reliant on foreign capital for since inception, really, and that's well recognised. I think, to Tim's point, it's basically the FIRB review process. Yes, that they used to have a statutory sort of 30-day process to get back with an initial sort of review of any applications, and that's been extended to 6 months. It's not that they may need the full 6 months, but certainly the review, the major focus, as Tim said, is around tax. What are the structures that are going to be put in place around paying tax in Australia and preventing the leakage there? That seems to be the main focus, and you can look down the list of ownership. Certainly politically, from time to time, there's some outcries occasionally in different regions about the ownership, but whether it's Chinese or whether it's from Europe or North America or other Asian countries, there's generally a tolerance provided that these things are sensibly structured, and there's no opportunity then for this leakage that would otherwise occur. But there's a large list of investors into Australia in the agricultural sector, but it still represents a relatively small proportion overall, and it is a necessary thing. Most of our farmers would agree that capital is necessary for their operations, and as Tim and I have both experienced, it has been a challenge to try and raise capital domestically in Australia to invest in some of these opportunities. And that's been something both of us and others have worked pretty hard on to try and educate people about the opportunity set. And perhaps one of the things that's coming out of this whole interruption and the focus around performance of different asset classes is that agriculture as a whole is probably stacking up pretty well in terms of, yes, it's not perhaps as volatile in terms of the asset values, and the necessity of being able to supply food to these markets that are continuing to have offtake is a promising thing. So, by comparison to some other sort of alternative investments that are out there, I think the track records that have been established and the information that's available is going to put agriculture into a pretty good light as far as an asset class.
I'd say if you're an LP from a developed world and in the form of a pension fund or an endowment fund or a family office, you're not going to have any problems in here. I don't think, coming to Australia. Probably to give him and my businesses a plug, it's going to be much easier if you go through a local manager.
Yeah.
Great. We have a few more. Do you want to keep going with Q&A, or do you want to get back into your talking?
I guess just one other sort of point, perhaps to getting back onto the topic of supply chains and the disruption. Obviously, for us as global food producers, the biggest disruption and change has been the restaurant trade has obviously been smashed over these past few months. But people still need to eat, and so what we've seen is obviously a big increase in eating from home and people home preparing meals, and that's had, again, some interesting dynamics depending on which commodity that you're actually involved with. So certainly industries such as the high-end providers of wines and the best cuts of beef have been impacted by that, and seafood as well in terms of the restaurant trade. But everyone's then been focused on, well, how do we go and access the markets at home? And that's had other impacts for other sectors perhaps that are more involved in that home cooking. So ourselves, for example, we have an investment in an organic flour milling business, which had really been challenged over the last few years because of drought in Australia, and the price that organic flour then represented because of the input costs of sourcing that organic grain. And from their perspective, the growth in home baking, but not only in Australia, but export wise, has really lifted their throughputs in the last few months. So they've been pleased with that outcome. But that's just one isolated example. And there's been some other sort of curious examples too. So our beef industry, certainly has had disruptions in their export markets to the traditional restaurant trade. But interestingly, the impacts of closures of meat plants in the US has then led to increased orders for Australian beef to fill that gap into the US market at a consumer level. So I guess what we're saying is agriculture and export trade, there's never a year that's the same as the last one with the supply and demand dynamics, and people who are in that trade usually have to be pretty flexible and have a whole range of different contingencies in place to divert product, and it's not unusual that they'd face those circumstances on a commodity by commodity basis previously out of Australia, with different tariff barriers or phytosanitary barriers that can come along unexpectedly. And I guess that's the resilience of some of our exporters have been quick to then look at where are the other opportunities. Citrus is another one that we're involved with, where certainly China's been a very large market and growing over the last 4 or 5 years for table citrus. And we know that we've got a lot of other unsatisfied markets for that product throughout Asia, which certainly this year is going to be a larger focus on building that, which in the end is hopefully going to lead to obviously a greater demand for our product across a wider range of markets. And we look forward to that opportunity. But in the short term, there might be we might need to be taking sort of 10% discounts on what we might otherwise have got if we're just servicing that one market of China. But if we can grow brands and supply to those other Asian markets, then there'll be a benefit down the track for having greater competition for what's obviously a limited supply out of Australia. Sorry, Kate.
No.
And I would add to that, given we are talking about supply chains, that Australia is relatively lucky, I think, certainly being isolated and an island, and so our mining and agriculture and construction industries have not been largely affected. Obviously, the supply chains have, but any domestic focused businesses have done pretty well. The Australian dollar, everyone knows, is very low, which is great for our export markets, and so we've seen disruption as Kim mentioned in the fresh produce side, which took a big hit initially. But our policymakers were very quick to act. We're one of the largest dairy producers down here, and the government very early came and saw us and spoke with processors and really worked out a plan as to how to keep supply lines open to what is an essential product. We've seen panic buying in things like our wine business. I'd imagine that gets pretty tough as we go forward if the global economy contracts a lot, particularly if export markets do get hit on wine. A lot of product might come back here, but again, over time, what we see, I've seen this since the 80s, these trade disputes and that pop up from time to time, and what happens is we just reallocate and it just opens up new markets. And so it's really just only ever really a short-term thing. The world is still short of protein, but it's worthwhile looking at the supply chain and what might come out of this. But certainly the demand for zero human touch food product should pick up. Demand for canned products, and even the workforce itself here, which I think Australia may benefit from. So zero human touch will lead to more automation. I think just getting used to doing things like we're doing right now, doing webinars online, remote working, inner city living, and high-rise offices are not what everyone thought they were. So maybe people will be wanting to live remotely in regional areas. So getting skilled labour for Kim's businesses and our businesses at Laguna Bay might become easier in regional areas. I think decentralisation of manufacturing is going to be a theme as we go forward. We're seeing massive closures of or mass closures of massive processing, particularly in, say for instance, American beef. So I think it'll cause everyone to reassess the risks that we didn't actually think were risks prior to this. And maybe you'll see more decentralised processing, and maybe we'll see post-global financial crisis, we saw too big to fail. Institutions have new regulation, and maybe we see regulation on essential industries, food, manufacturing of various things that we see local manufacturing, and certainly with gas prices and energy prices dropping in Australia, we had sort of pretty high energy costs, but that gas is the great facilitator to transition our power networks from fossil fuels into renewables, and certainly renewables is the lowest cost producer in the power complex. So even that alone will facilitate the transition to low power cost. Automation will help solve our high labour costs. So it could be that places like Australia end up manufacturing a hell of a lot more than we actually did before. And I think supply chains will probably have more inventory in them just as a buffer, which will mean a higher cost of capital, but it'll also mean we can probably do manufacturing here, where we are a long way from some of the markets. We're the closest to the greatest game in town being Asia. But I think you'll see, and you're seeing now, and you're hearing it, just a big policy push to do more stuff domestically here, which I think will add a lot more value to Australian agriculture, because we normally just put it on a boat and send it overseas.
To that point, Susan is asking if even anecdotally, if you are seeing the impacts of the pandemic trend away from globalization in any meaningful way in favor of locally sourced goods, particularly in the agricultural space. So have you seen evidence of that domestically, sort of a desire to focus people's consumption more locally?
Yeah, I'll take that one. So certainly, I think it's been evident over the last couple of years, at least, when looking at the US and China, and looking at Europe and looking at Brexit, that there's been quite a shift in the last 5 years or so to having more of a focus domestically. And in Australia, we're a pretty wide open economy. We've got, as I said, a small population relative to the rest of the world, and productive capacity in certain industries. We're reliant on trade. I don't think that we're ever going to turn our back on that. We certainly can't. But even ourselves, the policies here that the government are talking about now are, what have we got to do to look at across different industries to make sure that we're not entirely reliant on imports. And I think this crisis is going to certainly have everyone looking to run the ruler over what is our capacity to rebuild. It is the case in Australia that manufacturing has declined significantly from, if you went back 40 years ago, we're probably 30% of the GDP was in our manufacturing sector, and now that's less than 5%. So it's a massive change that we've become reliant on export markets, and in particular, that's been for us has been minerals, iron ore, coal, gas. They're our largest exports out of Australia by far, and agriculture comes in next across a range of different things there. But tourism has been also another big export, and education as well is right up there amongst the top 5 of what we export. Now, that education sector has been hard hit, so is tourism, for the fact that travel just isn't occurring, and we've got to work hard to try and see if we can win some of that back. But that's perhaps helped by the fact that Australia has got on top of the virus pretty well relative to the rest of the world, but that's because we shut the country down, and that's impacted those industries. So it's a matter now of how do we open up again, and how do we look at what are the industries that we could focus back on? How could we use our energy resources here more domestically as a cheaper input, and that's certainly the focus of the current government to pursue that. So they've actually put together a panel of some pretty high-powered Australian sort of entrepreneurs and industrialists to look at what can we do as an economy to change the mix and have less reliance on things that are critical for us.
Yeah, and on that point, we've got the greatest sun resources in the world, the best solar capacity here. So it's little things like that, and the gas prices will help facilitate that. Certainly, the push, and then the skilled labour into regional areas to get that to happen, and even things like what we just spoke about, and Kim mentioned education, which is being disrupted. A lot of schools now. Our son has been at home with us, homeschool for the last couple of months, and his school is going to keep that option open to parents to homeschool. So I think that's going to happen around the world, and I think you can live wherever you want in these regional areas, and your kid could probably go to any school in the world, and maybe any university in the world. So that in all these things come together, and I see this as incredibly positive over time for Australia, and I think the time is right to which is going to, I think, give huge tailwinds to these regional areas and agriculture in terms of being able to value add, do more manufacturing here, get more skilled labour in regional areas, and lower labour costs with more automation. Consumer demand now for safe, zero human touch foods with high integrity, traceability, and that push towards decentralised processing. And so all these things maybe confluence into, it's up to us, it's up to people like Kim and I to make this happen, to be frank. The policymakers want it to happen. I think all the bits that need to facilitate it are happening. And so really it's just brains and capital, and it'll happen, and it should happen in Australia.
Yeah, I guess to throw an anecdote in there around that, and again back to my old industry where I spent most of my career as cotton, and through the 90s, we did have a small domestic processing facilities here. We had names of spinning mills, just like the US has, and over that period of time, our labour costs just became too much to be able to compete against what was the imported product. So our entire industry of producing raw cotton became exported in 100%, and that was because we couldn't afford the labour rates. The automation in the spinning sector has meant that now there's very few labour units involved in that next stage of processing cotton, and running the numbers today, we could certainly be spinning all of that cotton in Australia quite economically, provided that we had long-term access to cheap power. And that's a frustration for a lot of us in agriculture here, that, as Tim said, we've got abundant resources of solar and wind and gas, but we have had as a nation a real focus around renewables and reducing fossil fuels, and we've actually, certainly to my view, handicapped ourselves with some very high power prices as a result, and that is perhaps the area of focus. How can we better access the abundant energy resources that we have to then create those first stage, second stage processing industries that perhaps that we have seen go offshore through automation, not necessarily requiring a big cheap labour force that we've been traditionally exporting our raw commodities to.
We'll stick with you, Kim. We've got another question. Can you comment? I don't know if you want to take this or not. It's kind of getting off the topic, but let's throw it out there and see what we come back with. Can you comment on the outlook for water rights in the core Murray-Darling Basin in the next year or two?
Yeah, certainly happy to do that.
Sorry, it's a little off topic, but I know that you have the mind to comment. So.
Yeah. Okay. Well, maybe just quickly share a screen on that too. So basically, the biggest challenge for Australian agriculture the last couple of years has actually been the drought, and we had a period from 2017 to 2020 where, as this chart shows, we had very low rainfall across this part of Australia. That's the major food bowl area, New South Wales into Queensland, South Australia, and even Western Australia, even Tasmania, which ordinarily wouldn't be the case, have all suffered from very low rainfall over that period. And the outlook presently is that we've certainly seen a change since the end of January. We've had good rainfalls. We've had continuation of that through most areas of the agricultural areas in particular over this past few months, and the outlook for the next 6 months is still very encouraging. So we're certainly seeing a shift in the availability of water, both rainfall and then at this stage, that's not yet been enough to start to contribute to a lot of the flows into the dams that support the irrigation systems, but it is encouraging, and we're starting to have catchments which are charged, and any further rainfall, if that does eventuate over the next few months, we should start to see things accumulating. The thing about water rights in the Murray-Darling Basin or anywhere else in Australia is that they're very confined. There's only so many on issue. There's not going to be any more dams built in the Murray-Darling Basin of any scale, because we've gone down a path of basically ensuring that our environmental flows are protected, that a proportion of the water, a large proportion, historically been 50%, but it's now closer to 65% of the water that would ordinarily flow through those rivers continues to flow through those rivers to the ocean, and that we're not extracting that proportion on a long-term basis. So what we're competing for is the balance of that, which is, it used to be 50% of the flows, it's now more likely 35 to 40% of the flows, depending on which river system that you're in. So that has been a driver of an increase in the value of water because of its scarcity. It's been a driver encouraging people to move water to its highest and best use, and that's by design. We've got a national approach, which is to consider that water is scarce, to then have a market-based system to allocate that across different competing users on the basis of the economics that they can generate out of using that water. And the purpose of that is to discourage using it for enterprises which don't derive a high value, that may be wasting that resource, that may be contributing to other environmental degradation through overuse, and instead provide some signals to then have that water move and transact to other enterprises. And what we've been talking about earlier, the growth of these markets and the food that they're requiring. One of the things that attracted me to pursuing an investment in water rights was simply that the challenges of servicing those markets. If you want to have a reliable supply chain, to consistently every year have a branded product being exported into those markets and maintain the continuity season after season, then if you're reliant on Australia's rainfall record, it's going to be challenging. And that was certainly my own experience in the cotton industry, where you'd have this tremendous volatility year on year in the amount that we could export. And so water becomes just this really important asset to be able to underpin reliability of supply chain. If we have the ability to irrigate crops, we can then increasingly invest in the sophistication of that particular farming enterprise and the outputs from that enterprise, and have some reliance year on year to develop markets and brands that will then have a consistent offtake, and in that case target premiums through that branding and through that product placement. For us, that then has led us to invest in things like citrus, where traditionally a lot of the citrus in Australia was just being juiced for a fresh citrus market, fresh juicing market. But the growth of these export opportunities has meant that we've been repurposing those orchards and changing the varieties over, grafting the trees into new varieties that are table citrus, that are increasingly seedless or easy peel, that are targeting those markets that are prepared to pay a far greater return. And so, currently, if you're looking at the prices for, say, juicing citrus at $200 or $300 a tonne, has historically been the rate that you would achieve, versus your table citrus, depending on quality, anything from $500 to $700 to $1,500 at the top end per tonne of product from those same trees that have grafted over to a new variety. And that's what's driving some of this change in water use and value. Likewise, for instance, the growth of the table grape industry in Australia. We've written these free trade agreements with Asia, a lot of different destinations: Japan, Korea, China, Thailand, Malaysia, and soon to be India and Indonesia. We're working on those. That's lowered a lot of tariff barriers. That's lowered the costs of doing business there, and has promoted these market opportunities where we can then grow these industries that are higher value use of that water, to underpin their growth. So in terms of the regulatory arrangements around water, it's very much a bipartisan approach. You know, we've got a long history here of recognising that the market is an efficient way to allocate the resource. There's no political will either side of the aisle here to change that. We've certainly had big reductions in the amount of water that we can access and put a cap in place, not only on surface water, but also groundwater, which is quite different to other parts of the world. So we can't just simply go and drill a well somewhere and extract as much as we like. We don't have the right to do that either. So we're operating in a cap and trade system, and therefore what's going on with water and its value is it's progressively being transitioned to higher and better use.
Thank you. Tim, you wrote a great piece specific to COVID-19 for Global Ag Investing. I encourage everybody to head over to gainews.com to read it. But Maggie's wanting to know, what is the biggest coronavirus-related risk to Australian supply chain? So maybe you can talk about a little bit of the different operations that Laguna Bay has and different products that you are involved in getting to market and what you see as the biggest coronavirus-related risk.
Yeah, the biggest risk I see is a shutdown of processing for perishable goods. So for us in our portfolio, it would be dairy, and we certainly don't want to be tipping milk down the gutter. So, which is happening around the world. So that's the single biggest risk I think for the whole world is that. In terms of just going forward. The whole distribution, and it's probably archaic, the original distribution systems of having distributors, walk into restaurants and knock on doors and charge 40% to the producer. That's been annihilated here because the restaurant trade or the on-premise trade here is just, or globally, has just stopped. And so I think a risk going forward is just there's things that we just probably haven't thought about yet as to when we tool up, as to where product might be short, and maybe where a lot of businesses just no longer exist, like that traditional on-premise distributor. So that's a threat and an opportunity, I think, as well. We can certainly, and my view is that technology can solve this, and particularly we're looking at in our wine businesses, at how do we disrupt that traditional distribution market, where really it's been cost prohibitive for many producers of many products to actually target that on-premise market. That distribution model is so inefficient and so high cost. So using technology to get access direct from producer into those thousands of on-premise locations, just and direct to the retailer. So I think that's the threat and opportunity. But to summarise, it's processing of perishable goods, I think, and also imports. We don't really know a lot of chemicals and a lot of imports for cropping. We sort of probably don't know. We've seen in our portfolio limited disruptions on that. We probably panicked, bought a little bit very early, but the crop's in now. And so I guess what we don't know is just, what hasn't been manufactured for the last few months. The other thing is just from in the capital markets, liquidity flows, which is something we certainly keep a big eye on. It's a question probably Kim and I should ask to the LPs in the audience. But, when we've got, reality is no one's done a roadshow for 8 weeks now, 10 weeks or whatever it is, and probably won't for another 10. So public markets have been raising capital quite efficiently, but the private markets have not been able to traditionally do what they traditionally do, which is go and have meetings and go and raise capital. So there's still capital being deployed by asset managers, but is there a massive liquidity hole going forward where we've also got a lot of temporary stimulus here. We've got the government have done a wonderful job. Some would argue too good. It's basically underwritten every business. So if your revenues drop by more than 30% here, the government will pick up the tab for your payroll, $1,500 a fortnight. across the board, and trading insolvent is no longer illegal, at least until October. So it just meant creditors and directors not panicking if businesses are in distress, tenants are getting rent holidays. So I think there's a lot. I don't think earnings hits have really flowed through to balance sheets yet, and I think that'll flow through and work its way out, and maybe that'll take time. Certainly there'll be a lot of businesses that will never reopen again, and so I think, you know, disruptions to liquidity is something also that we've certainly been concerned about. And as an asset manager, you just don't want to be caught short not having deployable capital if that happens, because you get tremendous opportunity. But I think, you know, that's something that Kate, potentially Global A Investing, can help to solve is, you know, how do you raise capital in private markets without doing site visits?
I hope so. I'm working hard overtime trying to get to the bottom of that very answer. I promise to report back as soon as I crack it. Kim, do you want to comment on that at all?
Yeah, well, I think, you know, to Tim's point.
Absolutely, absolutely. You'll be first to know.
Yeah, so certainly, you know, to Tim's point, I mean, you know, what are the governments doing about stimulus packages? And obviously, you know, on the news for here this morning was, you know, the EU considering what its package is going to be, and you know, the Australian government's rolled out very early on an extraordinarily generous package, and you go, okay, where traditionally, where is this all coming from? And you look then into modern monetary theory, and you go, okay, this is, you know, it's a dynamic which, oh, well, Tim and I, you know, our education was at about the same time, and we're going, you know, traditional textbook economics is just all out the window. And it's sitting here going, okay, well, with 40 million people unemployed in the US, with the stock market still where it is, you just got to ask the question. And I guess that's what we're doing is, okay, in the asset class that we're in, what are the implications here for access to capital and then longer term investment opportunities that, you know, are going to protect people's wealth through periods which, you know, we're going to go into an inflationary period if this gets out of control, if it's not managed well. And you know, the agricultural investment space is certainly one which, you know, had traditionally been very well correlated to inflation because we're producing food at the end of the day. So they are the things that I guess longer term, you know, out of short-term disruptions and what is the policy response, where are the opportunities for those who are thinking longer term around, you know, wealth protection and growing their wealth. And I still think that what agriculture offers is as an asset class probably overlooked for a long time, but it certainly needs capital, and food is still in demand.
And maybe I might add to that. So Kim and I caught up yesterday, and we were scratching our heads and having a laugh about this. If someone had given you a case study and said exactly what's happened, you know, GDP globally has dropped, whatever it's dropped, 10, 15%, unemployment rates is where it is. No one can travel. Everyone's stuck at home. Tourism's dropped by 98%. You know, what would happen to asset prices? You would say everything drops by 70% or something. There's Armageddon, right? So I guess what we've seen is policymakers willing to do anything. And there's still levers they can pull, right? We can, you know, we haven't really seen serious money printing yet. I think it's starting as we speak, and seriously negative interest rates and, you know, and just yield curve controls guaranteeing negative rates for 20 years or something. So I think policymakers will do anything they can to create inflation. And once it starts, it's going to be really hard to stop. So we've not seen it. And with that comes currency debasement. And it's back to probably what I mentioned in that report you spoke about, Kate, is agriculture is the ultimate defensive. It's the ultimate essential. It's the essential industry. All of us, no matter how wealthy you are, have walked into a supermarket and you just can't buy a product because it's gone, right? So we've all felt that vulnerability. Even going back to the world wars when you had conscription, farmers don't get conscripted because it's an essential industry. So going forward, you know, agriculture and good farmland doesn't really care what it grows and in what currency, or whether it's, you know, gold or renminbi or you know, the euro or back to the lira, or it doesn't matter. Agriculture is essential. It'll always be there. The farm will always be there, and it'll just readjust to sell what it produces in whatever the next currency is. But certainly, I think we are at risk, and higher risk than we've ever seen in our lifetime of inflation. And I did. I thought it was interesting. Warren Buffett at the Berkshire AGM last month said to someone who asked this question about inflation, he said, if you thought, if money printing really worked, do you think we would have only just invented it in the last 50 years? We would have been doing it for thousands of years. So clearly it doesn't work. It leads to all sorts of adverse consequences. So probably to answer that original question about COVID disruption, that's probably the big one we all should be asking, and particularly money managers wanting to preserve wealth, because the world is geared into into interest rate markets and stuff that doesn't do well in inflation. So I think there's got to be a massive reweight of capital into real assets and alternatives.
Yeah. Well, I hope that's right, because that's the song we've been singing for a long time. So I hope that's where the money lands. A couple of things I want to maybe just try to have more of a forward-looking, maybe a perkier note. You've mentioned technology a few times, Tim, and I wonder, I'm an ag tech nerd myself, so I was just wondering if you've seen anything coming across the pike that you think has promise or could answer these questions that you're posing. Have you seen companies developing these technologies, or are they more in your mind of a conceptual would be nice?
There's thousands of them, and as you know, there's billions and billions and billions of dollars going into ag tech. Matter of fact, it's a lot easier to raise money, I think, for ag tech than it would be for real assets, which is kind of ironic given the risk. So there's thousands of incredible technologies which will fall out. Nothing just springs to mind that I think is going to change the world, but my simplistic view is that we are not technology investors. We're early adapters of technology once it becomes commercial. So I think putting your footprint on large scale, the best farmland, water, that will be the best, that will be the highest returner out of this, being an early uptaker. So picking winners and losers in ag tech is not for me personally or our business, but getting ourselves positioned so we can uptake this and get advantage of dropping our costs through labour costs and automation and the like, and also doing things cleaner and greener, which is just, every day there's something we're reading about that comes over the desk that you think, wow, that's really cool if that works. So I think it's not one thing. I think it's happening, and Moore's Law's kicking in. It's happening really, really fast. And I think things like COVID are tipping points for this. We would never have had this panel session, Kate, a year ago. We would have, and so the world won't be the same again. And I think it doesn't have to be bad. It can be really good.
Yeah, just to add to that, I think in terms of the ag tech, the adoption is rapid around Australian agriculture when there's something that works, but often that requires capital too. So that's part of our function really is there are family farming businesses that dominate the sector here in Australia that don't often have they're not publicly listed companies that have a real challenge in raising capital other than bank debt. So they've got management capability certainly to do things differently, and oftentimes it's the lack of access to capital that's preventing them. And I guess that's particularly where we focus around how do we partner with some of those leading farmers who have that lack of capital, but they have a lot of expertise and experience to then go and apply these technologies and upgrade their assets through the use of those technologies, increase productivity and therefore generate a return for our investment capital. That's the focus, and there are lots of opportunities there across the world in agriculture, and certainly we see it every day in terms of the improvements that can be had. But like Tim, we're not an expert in picking winners, but of the ag tech sector, but we benefit out of applying it.
I'm definitely not asking either of you to pick a winner. I'm just wondering if you've seen companies specifically addressing these needs that are spurring out of the crisis, specific to automation or the no human touch thing that Tim was talking about earlier. Just wondering, is this being handled? Are people on top of it? Like I'm on top of funding the asset managers. for real assets.
And if there's one thing I think, particularly for Australia, it'll be traceability, because the white collar fraud in food production is so much worse than what anyone even could dream is possible. So a large percentage of what you buy is not what you think you're eating. And so as we get smarter and smarter, in places like Australia and New Zealand that are high integrity, and you'll go to jail if you do the wrong thing, traceability and getting closer to that consumer, it will be the big disruptor, I think. And all of a sudden you'll have massive shortages of products that you thought there was heaps around, but hey, it was adulterated. And honey, olive oil, we've spoken about this before. 70% of extra virgin olive oil is not. So there is a massive shortage of products like that, and honey, and you've seen it before, maple syrup. So you take the adulteration out with these nifty technologies that can just with the click of a button tell whether something's real or not. The consumer, not just the consumer, but boards around the world are going to have to protect the integrity of their supply chains. And so there'll be mass panic eventually and mass shortages of products. So if you're growing high integrity, high quality product, then I think it just gets more expensive and does better and better, and the rest just drops away to, ultra low margin, high volume stuff.
Yeah, I'd agree with that entirely, Tim. And we're seeing evidence of that in the dairy industry, in the wine industry, of course. And how do you protect that product? How do you have real-time data at the consumer end that provides that traceability with QR coding and other sort of geo mapping that can go on to ensure that when a consumer picks up a can of infant dairy formula in a shop in China, can scan a particular code to know that that can should be on that shelf in that shop at that time. And if it's not, you've got something that's counterfeit. For instance, Treasury Wine Estates are the leading wine business in the world. Their leading brand of Australian wine into China, Penfolds, is something which it's stated here that every single bottle of Penfolds sold in China has actually been filled 7 times. So the counterfeiting for that label is enormous, and they're absolutely addressing what they can do to ensure that doesn't occur.
And just that, if you tidy that up, will maybe half that market goes away, but half of it stays and half of it wants the real thing. And so the demand for the real thing is still there, but the supply halves or less. So I think we're going to see some big supply shocks, massive supply shocks. The other thing with COVID disruption is, we've not seen a supply and a demand shock in the economy before. And so we're seeing that now. And, that's very different to anything we've seen in recent history in terms of the economy. But, that's all I've got to add.
Well, that's our hour. I feel like we're ending on a bit of a dour note, but I think that the underscoring moral of the story is that properly managed farmland is going to be a better investment than ever before, and that the demand will always be there for traceable, safe, healthy food. And both of you are doing the good work to make sure that those in Australia and around the world continue to receive it. So thank you very much for all of your insights. This video will be posted to globalaginvesting.com. I encourage you to head over and check out the websites for Argyle Capital and Laguna Bay and learn more about these two very wise gentlemen. Thank you so much and have a great day.
Thank you. Thanks, Kim. Take care.